Hey, it's Rav. Welcome to the Everyday Investor TV show, the hottest investment show in the world. That's right, I said it. I don't care who knows it. This show is designed to help us everyday people become everyday investors, growing our money. You see, the challenge often is we take our precious time, we go to work, and if we have a job that we are blessed, I believe we're created to work, we get a paycheck in order to provide. We take our time, we go to work, we get paid so that we can eat. Imagine a life, though, where money could make you money, you could work a little less if you wanted to, and you could spend that time with family, friends, engaged in a purpose greater than yourself, something benevolent, something charitable. That is what this show is all about. Each week we interview guest experts in their strategy of investment so that you and I both can learn how to grow our money. Don't go anywhere. We'll be right back. On this week's episode, we speak to Andrew Kim, and he teaches us how we can invest passively in the USA.
Mission is how do we help others seek financial security by way of real estate? And like I said, everyone on my team, we've done it either professionally, personally, or for large institutions and others. So we want to kind of share the knowledge and the wealth of real estate.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey, it's Rav. Welcome back to the Everyday Investor, talking to our good friend Andrew Kim, who teaches us how we can make money investing south of the border, but my favorite way, passively. Andrew, great to have you on the show with me.
Thanks for having me.
Yeah, I was watching, we have a mutual friend, Erwin, and I was watching you on his podcast. And it was very interesting what you're doing, kind of a turnkey kind of situation. You've had other businesses, you've sold them. Talk a little bit about that one. One of your investors was one of the biggest, if not the biggest, talent agency in the world, WME, and they were a big investor. What was that business? You were living in California at the time as well?
Yeah, that's correct. Yeah, so we were working with YouTubers and helping them monetize their audience with merchandise. So at the time, YouTubers were generating so much content and having it millions of subscribers, yet they'd failed to make a living wage off of ads. So a lot of the YouTubers started saying, hey, come to my .com, get my content a couple of weeks in advance, and hey, you can buy my merch. So they started making $1 million on merchandise. So we're saying, okay, well, let's help you build that website, port over all your YouTube videos, and now you can merchandise your videos and make revenue on merchandise and commerce as opposed to just ads. So that brought us to the YouTube space and content creation, and LA made sense. So we had, the COO of YouTube as one of our investors, WME, Charles King, who I believe was previously also at WME, but now he's moved off on macro. He's the one behind Tyler Perry and all of the, and Kevin Hart, I believe. So yeah, had a lot of, Hollywood content talent money behind us. And then we eventually built that in LA, sold it in the Silicon Valley, had to move up there, and then eventually sold the company again and then moved back to Canada.
And are you what's your background? Korean?
Yes.
Korean, yes. And my favorite food, my best man at my wedding, Korean, Mark Kang. And I love Korean food. I was just in Florida for a month, and man, do I ever miss the ethnic foods that Toronto, one of the greatest cities in the world, has to offer. In Florida, love it, love the sunshine, but I really, I hope I'm not hurting anyone's feelings, but it was white man food, which I enjoy, and Mexican. That was it. In Toronto, I get both those, plus Korean, Indian, Filipino, Ethiopian, it's just Italian. It's just really great. There's a lot of good Italian places in Florida as well. We were in Naples. Yeah. But Andrew, I didn't tell you this when we spoke earlier or the other day. But the mission of this show is to help people to make money passively, work a little less if they want to, so they can enjoy things that matter most. Now, work might matter most to them, and that's fine, but if you don't want to do that, you could spend time with family, friends, benevolent things, things that are bigger than yourself, a purpose, a cause, and so that's why always the mission of this show is to help people grow their money, not so they can have lots of money, but what money can do for them. And what caught me is when you said, I sold my business so that I could be with my family, so that I could be with my wife, my child. Child, or you have more than one?
You have three.
You have three, yes. But that was the impetus, really, of moving back to Toronto and starting up a new business. And, the real estate world seemed right for you. And I know you have, 20 plus investment properties in the States and, yada, yada, yada. But it was because family matters most. And I think that's the most important thing that I want people to hear is spirituality, relationships. Those are the most important things in life. Money can help. And so that's why we have this show. What are your thoughts on that? Sometimes people get into this whole world of investing and real estate investing to create more time for themselves, but really they've just created a second, third, fourth job and it's not working out the way that they wanted it to work out. So touch on that for us a little bit in terms of even your company Share and the impetus and the thought behind it.
Yeah, when I started Share, I wasn't actually planning to build a real estate company. I was looking to invest. So kind of sidetrack, when I was living in California, when I first moved down there, I didn't have a family. I was just investing passively. I was real busy. But luckily I did, because as soon as I started to have a family, my sort of outlook on life kind of changed. And it was oh my God, what if I want to be able to have some balance. And if I wanted to take time off of work, I wouldn't be beholden to that paycheck. And I can now kind of have this balance and this amazing plan B to spend time with family and enjoy life. I just happened to be so fortunate enough that I did get into real estate and then, could live off of that, and then was looking to actually expand on that now that I've got 3 kids and the chaos has tripled. I wanted to kind of build more of a passive income or even just a bigger safety net. And it was actually the pandemic that brought me there, because I was thinking, hey, I was going to start a new business. But then the pandemic hit and I was oh my gosh, I'm going to have these kids in my life at home so much longer. Need to pad this runway, get back into real estate, because I know that is a very safe and reliable way to kind of have a financial freedom. And it was the pandemic that said, let me go back into real estate. And that's when I saw that gap. I'm this is such a hard task, but it doesn't have to be if you know how. And that's kind of where Share came in. It's look, I know the recipe. Let me share it. Let's build this thing so other people can experience life where it's actually enjoyable.
Yeah. And your company's there on the screen there. Tell me about that, the word share, and then the SFR, single family residence. But what does share mean? Why that name?
Yeah. So, our mission, it really is buried in our mission. Our mission is how do we help others seek financial security by way of real estate? And like I said, everyone on my team, we've done it either professionally, personally, or for large institutions and others. So we want to kind of share in the knowledge and the wealth of real estate. I could just spend my full-time effort building my own portfolio, moving horizontally in different types of real estate and landscape, but my mind is I'm going to build a platform for others. So really is about sharing the knowledge and sharing the wealth.
Okay. After the break, we're going to take a look at some of the numbers, that are projected here in terms of return on investment. I am born and raised in Kingston, Ontario. Moved to Vancouver for a while, live in Toronto, obviously now. The promised land of Brampton, Ontario. I didn't think there was enough Indians in Brampton, so I thought I would just increase the census for them. But I love the Greater Toronto area. When I go to the States, they think I'm nuts because of the taxes we pay. I love the GTA. I really do. But when it comes to investing in real estate and when it comes to investing in single family residences, the government can make it problematic. And I want to know why you chose to have your business and these properties that you're sharing with the Ravs out there that I can get in on, passively. Why the States? Tell me the difference between investing in real estate, single family homes in the US as opposed to Toronto, a place that both you and I love. But when it comes to growing our money, we can't be sentimental. We're not a charity. God blesses us with it, and we need to be prudent and wise. So tell me your thought behind that.
Yeah, so there's a few things. Let's just call it the politics and the legality around the states. So, there are multiple states that we look at, and we sort of bias a few of them or a handful of them. And the starting point for us is finding states that are landlord friendly and tax friendly. So landlord friendly meaning like, look, the U.S. single family rental market is a $4.4 trillion market, and we, 88% of that are actual like everyday investors. Mom and pop own less than 10 units trying to build generational wealth. So this is where a lot of people's hard-earned money go. And they need to have a secure investment and do so. So landlord-friendly states, tax-friendly states are sort of the starting point for us. We need to be able to control that. And then the variety and price point is also very important. Ensuring that there are large markets, large metros that have affordable housing, but also very good market dynamics. When I say that, it's like job growth, population growth that you typically won't see across Canada, maybe in only a few select markets, but they're very weighted disproportionately in Canada. So an example would be like Atlanta. Atlanta the greater metro's got north of 6 million, whereas, Alberta is probably the Texas of Canada. It's got 4 million. That's the whole province itself. So that's kind of where we're looking at. And then when you see the rental demand, they've got similar dynamics where sort of rental like demand is outpacing the inventory. So that is always a strong positive sign for investors.
And talk to me a little bit about Ontario. I mean, people here in Ontario, I did it with my mom when I was 16 years old. We bought a townhouse, and we actually moved out of a townhouse and then rented it out. And it was great, and, no problems. But what's happening, kind of these days? Share with me in a minute or so, and then we'll go to break. But what is going on here in Ontario when it comes to Rav that wants to buy, a single family home or a semi or a townhouse and rent it out? What would you say as Big Brother Andrew? Okay, Rav, you can do that, but here's some things that I want you to think about. What would you say?
Price point is way too high. It's pretty inaccessible. The mortgages, there aren't many mortgages for investors like there are in the US. There's a huge ecosystem for investment-friendly mortgages, as well as the economics in terms of what you'll get in return for rental income will be negative unless you self-manage. And even that is kind of towing the line. And if you want to be passive, self-managing is not the ideal way to go. And then when you look on a long-term basis, it's really hard to assess, how much rainy day planning money you should be putting in your back pocket, like in terms of vacancy and turning tenants over and how much you can raise rent. So one, I love Toronto, but it's a very tenant friendly province. So you can get squatters there, professional squatters. I've heard nightmare stories of people not paying for 9 to 18 months. So like, what does that do for your mortgage when your house is so expensive? So now you're out of pocket a lot of money. And then rent control, where, the rental, demand is through the roof, supply is on ultimate low. You can't raise rents higher than the rate of inflation. So now over 10 years, your returns are starting to be lower than your actual costs. So it's not growing in pace with your operating costs. So not exactly the greatest return curve. You're 100% banking on appreciation.
Yeah, and you're not, listen, there's a lot of Canadians that I respect that are doing the same thing, in terms of investing in the U.S. for the reasons that you mentioned. And, things change all the time, right? And government changes, and we just got to be Again, prudent and wise and shrewd and just kind of know what we're doing. Andrew, thank you so much for being on the show. We'll take a quick break. We'll come back and then we'll take a look at how share works and, kind of return on investment. Don't go anywhere. We're talking to our good friend, Andrew Kim, teaching us how we can make money investing in the States.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey, it's Rob. Welcome back to Everyday Investor. We're talking to Andrew. He's teaching us how we make money investing in the U.S. Andrew, great to have you on the show. You live right here in the Greater Toronto area. You have, how many properties does Andrew have? I think 20 properties? Yeah. You have that, yeah. And now you're helping other people do the same thing. So we're calling it Share Single Family Residences, Share SFR. Talk to me about how it works. Okay, so Rav believes you in terms of how challenging it can be to own property in Ontario. If you're an investor, so we now chose to do it in the States. I have a good friend named Anil Walia who's been on the show many times. You can't just say, invest in the States and Detroit is close or Buffalo is close. You got to do your homework. You got to do your due diligence. You got to make sure, as Mama always taught me, or Dada, that when you have more demand than supply, you're in business. And so, as you said earlier, before the break, we're looking at those areas. So Rav is in. Rav wants to invest. What's kind of the areas that Andrew likes? What's kind of minimum, purchase price in these kind of areas? And teach me also how it works.
Cool. Okay. Yeah. So, this is a bit of both how it works and how we would look. So we would try to understand what kind of investment property you're looking for. Are you an appreciation player, or are you like a cash flow? I really don't care about appreciation, because they're typically two different types of homes. Once we kind of understand that, there's that educational piece. We understand the price point. Then we'll say, hey, these are the regions we're going to go look. And a number of these regions will be, Texas, Georgia, Ohio, the Carolinas, Tennessee, Alabama, Kansas, and Missouri, those types of states. So Sun Belt and Midwest. We would understand that, again, what we call your buy box is a price point and return profile. We would then understand your financing strategy. What do you have access to? Is it cash? Is it a home equity line of credit? Or do you need financing? Work through those numbers, tighten those numbers up, and then we would start a search. There are some steps in between, but we won't go into that much detail.
So one point, Andrew, and I really appreciate you bringing it up. There is a difference between growing your money and letting your money not grow but spit you out like a bank machine. And that is increasing, your capital, which means appreciation is important to me. Or no, you know what? I need my money to spit me out money because I want to enjoy a certain lifestyle. But you generally can't have both. If someone says, hey, I want both, well, okay, you buy a property, it'll increase a little bit and you'll get a little bit of cash flow. So there is that option. But a lot of people don't necessarily need cash flow because they make enough in their day job and they're not looking for 100 properties to retire on. They want 4 or 5 or whatever the case is. Or there's people that want cash flow. So I'm glad you brought that up, that you can have growth, which really is what yours truly wants right now. Later, of course, I want cash flow, but I'm 52. I like my day job. And I do okay with that. Thank you, Graybrook. So I want to just grow my money, but there'll come a time where I want cash flow, and it's to each their own. And then you can also have both, but if you have both, you're getting a little bit of both. So thank you for bringing that up. So you assess my kind of investor profile, what I'm looking for, and then we go from there.
Exactly. And to kind of like simplify things, I would say like on the cash flow side, these homes would be around $150,000 range. And then on the higher appreciating asset side, it would be around the mid $300,000 range. And then those would be across the Sun Belt or the Midwest. And what we do is once we kind of finalize that, then we move into financing strategy, understand sort of what you have access to, whether that's a home equity line of credit, cash, or if you just have a little bit of cash and you want to go with a mortgage, we'll help you find that for you. We'll put those numbers together. Once you understand those numbers and the expected returns, we start searching on your behalf. And our system runs through all sort of on-market deals and off-market deals. On-market deals being on anything listed on like a MLS, a Zillow or a Redfin or Realtor.com, and off-market being large wholesalers and institutions that are offloading their properties. Once we find a match, then we would present it to you, say, hey, look, this home matches your buy box. Do you want us to go in there and do a full diligence? And if you say yes, we'll send a third-party inspection company, our contractor, and a property management partner to go into the house, give us a full report, a renovation quote, and we'll tighten up those numbers. And if they still look good, then you have a decision to make as to whether or not you'd like to go to purchase it or terminate the contract and keep looking.
Okay, so I know what Anil, my buddy, would say to me. He would say 0. I'm going to ask you the next question, and it doesn't matter if you say 5, 20, of your 20 properties, how many did you go and look at before you purchased?
0. So I'm in the same boat as your friend.
0, because once you put things in place, there's no need to. It's not like, again, the people are in place, and that's what Share has done. It's put the people in place. So it's my prerogative, Rav, if I want to go see it or not, but I really don't need to. A guy who's steering the wheel here hasn't seen his. And again, like I say, I have friends that they haven't seen theirs either, as long as just all the things kind of fundamentally make sense. So you're saying you take care of everything. This is A to Z. Now, I've heard you say on Erwin's podcast, but don't be foolish. Make sure you know what you're doing. Don't just, give your money. I should also invest time to be able to understand everything. But in terms of, having to even leave my house or computer, I don't need to do any of that. Share is a one-stop shop, A to Z.
Correct. Everything. You will know as much as we know about a property before making that purchase.
Okay. Now, when I want to, let's say I'm interested in appreciation, kind of like Toronto, it's going to be more expensive. I'm not going to make much cash flow. I actually probably be negative in Toronto if I'm only putting 20 to 30% down, but hopefully it increases in value and so on and so forth. You're saying the same thing. We're going to these pockets. My price point might be 300,000 to 400,000, but it's going to increase in value more because they're better, not better cities, but there's cities where there's, more employment is perhaps lower. People are moving to that city, so on and so forth. So it's going to increase in value. If I'm looking at cash flow, I can even $150,000. And are we still trying to follow the 1% rule, or is it a little bit higher in terms of, like, let's say I buy something for $150,000, my rent would be $1,500 a month. Are we still kind of in there, or has things changed a little bit?
Yeah, it's kind of in and around that rule. The way we would look at it, and I'm not sure if I'm familiar with sort of the cap rate measurement, but in the higher cash flow homes, we've been looking at the high 6s, low 7% cap rates.
Yeah, that's a difficult concept. I mean, I understand it, but it's you're like, wait a minute, why is it a higher cap rate, but it's lower price, so on and so forth. But yes, you're looking at that, and that's why it's a great way to do that. Speaking of cap rates, why does Andrew enjoy 20 single-family homes, like Anil, my friend, more than that, single-family homes, as opposed to 20 units under one roof? What is your personal thinking there? Because by the way, for those that are watching, there's a lot of big companies, the biggest real estate companies that are buying up apartment buildings. But there's also big companies, and some of the same ones, they're doing both, that are doing exactly what Andrew is doing, and realizing that this is a great asset class, single family residences. So, Andrew, why not 20 units? Why not a 20-plex as opposed to 20 single families?
Yeah, so when I first started, I considered the same thing. The price point was just more accessible for a single family home than a multifamily unit. So the cost of getting in without having to go raise money from third parties to get the down payment and do all the business work. It was just my hard-earned cash to go in. But in terms of like why I still do single family and what we call scattered single family, so it's spread across multiple states, is that, that way you get real diversification because, the job composition in like in Atlanta will be very different from the job, composition in like Columbus, Ohio. So I'm not beholden to sort of any economic fallout or changes of a certain region, or if they decided to change some of their laws, their tenant or landlord laws in a certain state, then all my portfolio is not, under that sort of same scrutiny. Whereas, if you had a 20 unit multifamily in that one area and they make one change to a landlord rule, then that whole building is now sort of compromised.
Great point.
So it's diversification.
Yeah. Okay, let's look at a quick example. So Rav's in, I want to buy a property. Give me an example.
All right. So I would say I'm a big fan of B-class neighborhoods. So, modest appreciation and modest cash flow. So price point would be in the mid 200s, like 250.
250.
And let's call it Atlanta, in the greater Atlanta area.
Okay. Atlanta. I'm buying this for 250. Okay. Am I doing this cash just for the example, or what am I doing?
Yeah, let's do all cash for the sake of simplicity.
Okay. So purchase price is this. It's all cash. Okay. So I'm buying a single family. This is what? 3 bedrooms, 2 washrooms? What is it?
Exactly. 3x2, approximately 1,500 square feet.
Okay. 2 bath. And this is going to increase in value, what percent?
So we do a modest 5 or 6%, but we know that historically this can be up at towards 9 to 11.
Okay, let's use 6%. 6% of 250 is what? 15?
9.
9.
Oh yeah, sorry, yeah. 15.
15K.
Yes.
All right. Now, I'm buying it cash, so no one's paying down my mortgage. So my cash flow, I'm renting this out for what?
Approximately, let's call it 22 to 2,400. So 2,300, let's call it.
2,300, and what's that times 12?
That would be 46.
27, 28?
27.6.
Let's just put 27. So I'm making 12. I'm making 42K. So do you have a calculator there? What's 42K divided by 250? What percent does that spit out?
16%.
16%.
16.8.
Yeah. And so this is an ROI yearly of 16%. You've used conservative numbers, but the whole point of this one is I am making over $25,000 a year.
Yes.
Cash flow.
Gross, yeah.
Cash flow.
Yeah.
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 And so this is kind of what we're looking at here. If I want to up the cash flow, then maybe I buy a property somewhere else that's $100,000. Correct?
Yes. Correct. Yeah.
Okay, so what's next steps? I mean, and we've got 30 seconds here. Time flies when you're learning, and I really appreciate it. We'll have to have you back. What if somebody's watching the show, they just go directly to the website and we can start there?
Yeah, so go to the website. You can create a free account. We have a questionnaire and then book a call with us. And then we will start giving you some sample homes with the expected returns and then go through the same process of learning. Also, if you create a free account, you can look at some of our past properties as well. Okay.
Listen, Andrew, appreciate you and appreciate you teaching us and, kind of providing this. I mean, obviously, in this, there's a few bucks that, you got to feed your wife and kids as well. But it's a great opportunity for people to passively, get into real estate and you take care of everything from A to Z. So thank you so much for being on the show with me.
Thanks for having me.
Yeah. And thank you to the viewers for watching. Without you, we would not have a show. To watch the show again or to see any of our other episodes, please go to everydayinvestor.com. It's like kind of watching on demand. Until then, we'll see you next week. Same place, same time. Honey, I love you. I'll be home soon. Bye, everyone.